Welcome to this explainer. If you're looking to literally hack your financial future, you are absolutely in the right place. Today, we're taking wealth building from some abstract pipe dream idea and turning it into a highly structured, actionable blueprint. And the central truth of our journey today is so simple. Investing early is the ultimate cheat code to growing your wealth. So think about it. How much does it actually cost out of pocket to become a millionaire? Seriously. Most people assume it takes a massive inheritance, right? Or maybe founding the next big tech startup. But honestly, building $1 million portfolio doesn't even require a six-figure salary. It really all comes down to a single incredibly powerful variable: time. Just look at the jaw-dropping contrast here. Assuming a pretty standard 7% average annual return, if you start at age 18, you only need to put away $254 a month to hit $1 million by age 65. But what if you wait until age 55? Wow, you are suddenly looking at a staggering $6,032 every single month just to catch up. Starting early drastically, and I mean literally drastically, lowers your out-of-pocket cost. It's like magic. All right, here is our blueprint for today. First, we'll hit the power of time. Second, figure finances out. Third, maximize retirement. Fourth, diversify with ETFs. And finally, protect your wealth. Let's dive right in.
Part 1. The power of time and the absolute magic of compound growth.
When we talk about building wealth, we're really just talking about compound growth. That means earning a return on your money and then earning a return on that return. It's a beautifully simple formula. Regular investments plus time equals wealth. Think of it like a snowball rolling down a really long hill. The earlier you start, the longer the hill. By consistently investing a set percentage of your income and just leaving it alone, you give that snowball the runway it needs to become absolutely massive. It's not about timing the market, it's about time in the market.
Moving on to part 2. Figure finances out first. We need to calculate your net worth. Because here's the deal. You can't build a sturdy house on a shaky foundation, right? Before aggressively investing, you have to calculate your current net worth. And it's actually super simple. List your assets, what you own, like savings or the value of your car. Then list your liabilities, what you owe, like student loans or credit card debt. Subtract your liabilities from your assets and boom, there's your net worth. And hey, don't panic if it's a negative number right now. That's totally normal. Tracking this annually is simply how you measure your progress over time. Now, to actually leave room in your budget to invest, you've got to take control. First step, eliminate high-interest credit card debt. I mean, no investment strategy is going to magically outpace a 20+% interest rate. It's just math. Next, control those large expenses, like massive car loans. Third, build an emergency fund in a federally insured bank so something stupid like a flat tire doesn't derail your entire future. And finally, pay yourself first. Automated deposit from your paycheck straight into your investments so you never, ever even miss the money. All right, part 3, maximize your retirement accounts. Let's talk 401ks and IRAs. Now that you actually have money ready to invest, where should it go? Well, if your workplace offers a 401k, you definitely want to start there to maximize those sweet tax breaks. For 2026, the annual contribution limit has actually increased to $24,500. And even better, a lot of employers offer a match. Listen closely to this. An employer match is literally free money. If you aren't contributing enough to get that match, you are leaving free money on the table. Don't do that.
Now, beyond your workplace, you can really accelerate things with your own personal accounts. For 2026, the IRS limit on annual contributions to an individual retirement account, or IRA, is up to $7,500. You set this up entirely on your own, and it gives you a phenomenal second block of tax-advantaged investing to keep your money compounding and that snowball rolling.
But what if you're getting a slightly later start? Don't worry, the IRS provides catch-up rules. Starting in 2026, employees aged 50 and older can add an extra $8,000 to their 401k. And under the Secure 2.0 Act, there's an even higher limit of $11,250 that applies to those aged 60 to 63. These rules are specifically structured to help older workers aggressively close the gap. Moving right along to part 4, diversify with ETFs. This is where we master asset allocation. Opening a 401k or an IRA is kind of just like opening an empty bucket, right? You still have to choose what actual investments to put inside of it. You've definitely heard the saying, don't put all your eggs in one basket. Well, if you sink absolutely everything into one company's stock and they happen to have a terrible year, your financial future takes the hit. By spreading your money across many different industries, you protect yourself. A super common way to spread that risk is by splitting your investments between different asset classes. So, stocks for higher growth potential, bonds for steady income, and cash for security. You adjust this mix over time based on your specific timeline. Actually, target date funds do this automatically for you. You just pick your target retirement year, and the fund shifts from an aggressive stock-heavy mix when you're young to a much safer bond-heavy mix as your retirement approaches. Pretty cool, right?
One of the absolute best tools for instant diversification is an exchange-traded fund, or ETF. Think of an ETF as a massive pool of money from tons of different investors, used to buy a huge, diverse portfolio of stocks or bonds. Buying just a single share of an ETF gives you fractional ownership of that entire portfolio. It's a brilliant, highly efficient way to just buy the whole haystack instead of obsessively looking for the needle.
And this is exactly why ETFs are incredibly popular nowadays. They offer broad diversification for a very low minimum investment. They're also highly liquid, meaning you can trade them pretty much any time the market is open. But their real secret weapon? Tax efficiency. Because of how ETFs exchange their underlying securities, they typically trigger way fewer capital gains taxes for you compared to traditional mutual funds. So how do these ETFs actually make you money? Basically in three ways. First, dividend payments. The fund passes its earned income directly to you. Second, capital gains. If the fund profits from selling a security, you get a cut of that. And third, increased market price. If the fund's overall holdings go up, the value of your shares increases. Notice that absolutely none of this relies on you frantically day trading. Research consistently shows frequent trading usually harms your returns. Just set it and let the market work for you over time. Finally, Part 5. Protect your growing wealth. Let's talk about how to avoid fraud. As your accounts grow and that snowball gets bigger, you naturally become a target, so you have to be vigilant. Watch out for the red flags of fraud. Scammers love to use texts and social media to pitch bogus investments. If anyone, and I mean anyone, promises guaranteed high returns with zero risk, you need to run the other way. All investing involves risk, period. Be highly suspicious of unlicensed professionals, weird group chat pitches, or fake SEC endorsements. Anyone promoting an easy overnight windfall is literally just trying to steal your snowball. Well, we've covered a ton of ground today, but knowing the blueprint simply isn't enough. You have to actually act on it. Because time is the ultimate wealth-building variable, every single day you wait is a day of lost compound growth. So I'm going to leave you with this challenge. Time is ticking. What is the very first step you will take today to start building your wealth snowball? Are you going to calculate your net worth, maybe automate your deposits, or finally check on that 401k match? Take that step right now and let time do the heavy lifting for you. Thanks for hanging out with me on this explainer, and happy investing!